What's up everyone, it's Caddy with Money Investing. So in this video, we are going to be talking about the Fed's balance sheet, which just keeps on swelling up week over week. And yes, the Fed also added another close to $100 billion in just 1 week alone. And we have pretty much given back about 60% of the quantitative tightening that we did in the last 1 year in 2 weeks. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining us and of course getting access to all the alerts, binds alerts, options alerts, trade ideas, and all the benefits and tutorials and lectures, there is a 16% annual discount that does expire at the end of this month. And fundamental and technical analysis courses, the bundle is currently 40% off if you want to take advantage of that as well. Both links are going to be down in the description below. So this right here is going to be the total assets on the Fed's balance sheet. These are all securities held outright plus the loans. And as I've talked about before, the Fed's balance sheet is pretty much made up of two things: lending activity and investment activity. Investment activity is all the securities held outright. These are your mortgage-backed securities, agency debt, and treasury securities as well. And then you've got other lending activity, which is primarily consisted of loans that the Federal Reserve pretty much lends out to other banks, bridge banks, other central banks from around the world. So again, investments and loans are the two building blocks pretty much the Fed has on its balance sheet. So this is going to be all assets, and as you can see that it actually did go up to $8.7 trillion. We are now pretty much back up to all-time highs. This is maddening. This is crazy because this is once again the Federal Reserve just printing money and giving out loans in exchange for collateral. And hopefully, I really hope that it's not inflationary in nature, but we'll find out soon enough when inflation reports start coming out. But you'll notice that we peaked in around May and June of last year at around just shy of $9 trillion. And we're $200 billion away from eclipsing that high. And if you consider the current GDP of the United States, which is at about $33 trillion, give or take a few $100 billion because it's so large, 8.7 divided by 33, 26% right now is the Fed's balance sheet as a percentage of the gross domestic product, as a percentage of GDP at the moment, which again is pretty substantial. And we're coming off of 8.3, so we are coming from 25% to now sitting well over 26.3%. So we have pushed higher, and the Fed's goal or the target range is for us to come down to about 16 to 18%. And the Fed, was looking forward to, or really was expecting to roll over a couple of $1 trillion worth of securities and to shrink the balance sheet. That was the process or the path that we were on. But now 2 consecutive weeks, we've seen back to back the Federal Reserve's balance sheet kind of expanding. Now, there was another record where a Fed foreign central bank tool gets tapped for a record $60 billion. So a Federal Reserve facility that gives foreign central banks access to dollar funding was tapped for a record $60 billion in the week through March 22nd. And that's according to data published by the U.S. institution on Thursday. And the rate on so-called Foreign and International Monetary Authority's repo facilities, so repurchase agreements, currently 5%, generally exceeds the cost of funding in private repo markets when the U.S. Treasury market is functioning well. So the facility will primarily be used only in times of unusual market stress. So because the rates are so high, this will only be tapped if there is a very unusual market stress in the economy and its absolute need for this foreign central bank to borrow from the Federal Reserve. So on the Fed's weekly balance sheet as of Wednesday, released this afternoon, we find some interesting stuff about liquidity facilities that the Fed rolled out, dusted off the Silicon Valley Bank signature bank failure, collapses, and of course, Credit Suisse taken over by UBS under the support of the Swiss government. So here's a summary. Discount window pretty much declined a little bit. So we did have some banks pay back the Federal Reserve, and that's declined to $110 billion. Central bank liquidity swaps, no activity. So we did learn from the Federal Reserve earlier, I think it was last week, when they mentioned that they are going to be opening up their US dollar swap lines to other central banks. There's this Bank of Japan, Bank of England, Bank of Canada, and then Swiss National Bank as well, and then some of the other central banks around the world, where the frequency is going to be switched from weekly to daily, but no central bank kind of tapped into that. So that's good. However, the repos with foreign official, that went up to $60 billion, or that increased $60 billion on the Fed's balance sheet. So in other words, there were repurchase agreements. So the Federal Reserve is lending all this funding, $60 billion, to this foreign official, which was, again, unnamed. It didn't really mention who it was, with central bank. And in return, they pretty much took in collateral, which is, government bonds, mortgage-backed securities, all that stuff. Now, there are expectations that this was a Swiss National Bank because they are providing some liquidity to UBS in the tune of $100 billion, as well as $9 billion of absorbing losses with this acquisition of Credit Suisse. So there are expectations that this was Swiss National Bank, but we don't know, right? There's no confirmation that this was $60 billion actually did go to that foreign central bank, but we know that $60 billion was lent out. Bank term funding programs, so BTFP, increased $42 billion to $54 billion now, and credit extension to FDIC bridge banks also increased $37 billion to $179 billion. So overall, all in all, close to $400 billion is the amount. So if you add all of this up, 110 plus, let's just do 60. Let's see, 60 plus 54. Plus 179, we're sitting at over $403 billion. And again, if you add 6.3 plus 0.4, $6.7 trillion, that's exactly where we are sitting right now, 8.7. So 8.3 plus 400 billion, we're sitting at $8.7 trillion. So not 6, but 8 trillion. So $8.7 trillion where we are with the Fed's balance sheet. So they have pretty much added close to $500 billion in the balance sheet in the last 2 weeks alone through FDIC bridge loans, the unnamed and suspicious foreign central bank tapping into the repos, close to $60 billion. And then, of course, we've got the discount window at $110 billion and the new program, bank term funding program, at $54 billion. So repos with foreign official counterparties, and again, Swiss National Bank, so rose $60 billion in 1 week from zero. And the Fed has standing repo facilities to engage in the repo market, which is repurchase agreements. Here's we're talking about repos, an asset on the Fed's balance sheet. This is when the Fed essentially lends money to counterparty against collateral consisting of treasury securities or agency mortgage-backed securities. And there has been no use since the summer of 2020 when the Fed raised the interest rates and charges on repos yesterday as part of the rate hikes. It raised it to 5%. So again, it's kind of like the lender of last resort. So whoever is on the other side of borrowing this amount definitely needs it desperately in order to facilitate this deal. And this is likely where Swiss National Bank got the $60 billion liquidity to support the Credit Suisse take under. Again, this is just the speculation. We don't know for sure. But this is the increase in the repo market, repos on the total balance sheet of the Federal Reserve. $60 billion. And again, we're going to find out, how all of this kind of plays through into the economy, not just in the US, but of course over in Europe, because now we also have Deutsche Bank that's kind of struggling with a very similar situation. This is one of the worst performing European banks, and you can see that Deutsche Bank registering a loss of about 20%. I think right now pre-market it's down over 10%. I did a video on this yesterday, so not really doing super well. So definitely keep a close eye because, it's in a very similar situation as Credit Suisse. But one thing to note here is that the credit default swaps on Credit Suisse was over a 1,000, whereas Deutsche Bank, it is still over 400 or 500, I think last time I checked. So it is half of what Credit Suisse was. So the default risk is increasing, but it's not as substantial as Credit Suisse when it failed. But this is, again, one of the biggest banks in Germany. So, Deutsche Bank going down, it's a SIB, so systemically important bank. It's going to be a pretty big deal. So keep a close eye on this. And again, the Fed is doing what it can to inject liquidity as much as it can to print more money. We'll find out eventually how all of this plays into, the economy and what's going to be the repercussions of all of that. But let me know in the comment section below. What do you think? As always, if you enjoyed this video, find it helpful, make sure that you drop a like, subscribe to the channel. It's always happy investing. I'll see you all in the next video.